Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA N Raja, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice. Had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar.
Let's understand about reserves. What do we mean by reserves? These are all basically part of profits which are set aside and retained in the business. See, generally when business makes a profit, it is basically for owners, and if the management feels, they can distribute all the profits to the owners in the form of dividends. But instead of distributing all the profits, some profits are going to be set aside and retained in the business. Why it is done? It's basically to meet the certain future needs. They may be requiring funds in future for growth purpose, for expansion purpose, or for meeting some future contingencies. So for those purposes, funds are set aside. So reserves are basically appropriations of profits. And reserves, they basically strengthen the financial position of the business. How? If you look at the balance sheet, the sources of funds, one is funds contributed by the owners, we call it as equity. The other one is outside liabilities. Equity mainly share capital, and this share capital, with that all the reserves as well as the surplus will be added. So that will increase the equity, and when there is going to be more equity in a business, then that business will have more solvency. Okay. So reserves actually strengthen the financial position of the business. And one thing we have to understand, reserve is not a charge against profit. Let's say this is your P&L, you make a sales of 100, you incur an expenses of 70, you make a profit of 30, right? So this profit you will be using for paying taxes. Let's say you pay tax of 10, it means you are left with profit of 20. And it is only this profit which can be retained in the name of reserves. So reserves is not part of expense. Reserves are basically appropriation of profits. And these reserves, they can be for general purpose. They can also be for meeting something in future. But this is different from provision. Provision is always a charge against profit, and they are basically known for or created for meeting a certain specific liability, whereas reserve, it is an appropriation of profit. And the creation of reserve actually reduces the amount of profits available for distribution. Yes, look at the same example. There is a profit of 30. You pay 10 as tax, and now you have reserve of 20. And out of this 20, if you are going to, that is, here you have a balance profit of 20. I said reserve of 20, we'll say it as balance 20. And this balance profit of 20 can be used for reserve purpose, can also be used for distribution as dividend, right? So out of this 20, if I'm going to use 15 for reserve purpose, that is, if I'm going to retain 15, then only 5 is available for distribution as dividend. Okay. And where we will be showing this reserves, obviously in the balance sheet under equity segment, this will come under reserves. This will be item next to the capital. What are some of the examples of reserves? We will come across statutory reserve, general reserve, share premium, say like workman compensation fund, investment fluctuation fund, capital reserve, dividend equalization reserve, then reserve for redemption of debentures and all. Now, why reserves are very important? See, already I have highlighted, reserves are set aside from the profits. maybe for various purposes, for expansion, for meeting contingencies. So this is basically a mechanism to protect the business from the consequences of unknown expenses, unknown losses. Okay. By creating reserve, what we are doing, we are restricting or we are reducing the amount that can be withdrawn by the owners in the name of dividend or say withdrawal of profits, right? So reserves can be for expansion, future contingencies, meeting the future contingencies, strengthening the financial position. Even it can also be created for redeeming some long-term liabilities like redemption of debentures. We can also classify the reserves as general reserve and specific reserve. General reserve means these are all the reserves which are not created for any specific purpose. It means they are general in nature. So we also call them as free reserve because management can use them for any purpose. But the benefit of general reserve is it will strengthen the financial position of the business. Then what is specific reserve? These are all the reserves which are created for specific purpose. It means they can be utilized only for that purpose. Let's look at some of the examples. Look at here, dividend equalization reserve. This reserve is created to stabilize the dividend rate or maintain the dividend rate. So what they will do, in a year, if a business makes high level of profit, they will transfer certain amount to dividend equalization reserve. So in the year of low profit, they can use this particular reserve amount to maintain the rate of dividend. Then there is also something known as workmen compensation fund. This reserve will be used for providing for the claims of workers which may arise because of accidents and all. Then we have investment fluctuation fund. These are all created to provide for decline in the value of investment which may arise because of market fluctuations. Then debenture redemption reserve. This is created to provide funds for redeeming the debentures. So these are all the classic examples of specific reserves. We can also classify the reserves as revenue reserve and capital reserve. This is as per the nature of the profit. When we say revenue reserve, these reserves are created from revenue profits. It means they arise from the normal operating activities of the business and they are freely available for distribution as dividend. So these reserves are freely available for distribution as dividend. Example of a revenue reserve can be this general reserve. Then what is capital reserve? These are all the reserves which are created out of capital profits. These reserves, then what is capital reserve? These are all the reserves which are created out of capital profits. They are not from normal operating activities. So these reserves are generally not available for distribution as dividend. They can be used for writing off some capital losses or they can be used for issue of bonus shares and all, but they are generally not available for distribution as dividend. And example of capital profits or capital reserves can be like premium on issue of shares or debentures. Let's say 100 rupees share issued for 120 rupees. So this 20 is a premium and that is a capital reserve. Then profit arising on sale of fixed assets, profit on redemption of debentures, profit on account of revaluation of fixed assets, liabilities, profits which are prior to incorporation and profits which are arising on reissue of forfeited shares. All these are example for capital reserves.
Are you a bank executive looking to advance your career in credit or advance profile in SME and corporate banking? Do you want to learn the pre-sanctioned credit and financial analysis skills that are essential for success in this field? If so, then our course, Credit and Financial Analysis Mastery Bundle, for bankers, is for you. In this comprehensive and structured online course, you'll learn the pre-sanctioned credit underwriting process, covering credit analysis and financial analysis specific to SME and corporate banking credit. You'll be guided through each and every step of the process, from understanding the basics of credit analysis to assessing term loans as a banker. With 15 modules and a variety of ebooks and other resources, you'll have everything you need to master this highly sought-after skill. Our course is pre-recorded, so you can access it any time, at your own pace, without disturbing your official working hours. Plus, you can access it as many times as you'd like and even download it to your mobile device for offline viewing. When you complete the course, you'll receive a certificate of completion. And with lifetime Q&A support through our Telegram group, you'll have access to the guidance and support you need to succeed. Don't miss this opportunity to advance your career in credit and financial analysis.